Okay, welcome back, folks. Okay, we are continuing our series this week for aiming for a 6% return for the month. I think that's a good low-end objective for an aspiring trader, even if that's all you ever amount to do as far as consistency. It blows away everything out there in terms of managed funds and all that. So I sent you a tweet regarding the British pound USD, something to study, and we're going to cover that real quick, and we're going to look at the dollar and give you something that's salient for right now and recap what I was leading your attention to. Everyone that's new, obviously, they have some work to go through for the September content, but we talked about a specific idea or concept as it relates to liquidity runs. Now, liquidity runs are going to be your bread and butter trade. They're the ones that you're going to find them all the time in the charts. They're in every time frame. You'll be able to see these in just about every trading day. There's one that's forming. It may not be in the pair that you're looking at or studying right now, and that's good. That's why I want you focusing on just one pair, because there's going to be times when there is no setup and you have to wait. And that waiting point, okay, that patience factor is essential, because you need to understand when there is no opportunity in the pair you're trading, and exercise patience. Don't force your will on the marketplace. So what I'm going to go over today quickly is the present condition on British pound and the dollar index, and then we're going to take a look at how we can go in and start framing setups that could help build our 6% goal. It's going to be kind of brief this morning. I already warned you ahead of time with the duration, with why I bracketed out the time 9 to 9:45. So I'm going to try to do it in 40 minutes. Very little to talk about specifics, because it's pretty straightforward. So let's get right into it. I sent a tweet highlighting the liquidity pool, which is taught in the September content. And there's another liquidity pool resting below these lows here. Now, if we look at old lows, especially on a daily chart, and I'm going to ask this rhetorically, I'm not really following on the questions box, because I know some of you are actually posting stuff. If I look at that, it's going to make this session a lot longer than it needs to be. But we have an old low, and we have another old low over here. Who trades primarily off of a daily chart? Smart money, the banks, large institutions. So if we understand that that's the animal that lives, see, that Brexit thing screws me up. I gotta get that out of there somehow. Well, it'll have to stay like it is for now. This low has sell stops below it, and this low has sell stops below it. And one of the questions I've got was, how do I know that there's sell stops? Am I reading something? Am I getting private information? Am I getting some kind of information directly from an institution? And it's obvious, okay? Whenever there's a low that's formed in the marketplace and price starts to expand away from that low, the understanding is this is part of the role-playing model that I teach you. You have to assume, like a market maker, that when the market rallies away, some entity is long. And if they're long, they're going to be looking for protection on that long position. Just like anyone else, if they're long, they're going to protect that long position with a sell stop below a recent low. Now, how far back in terms of that low they're going to look for is relative to the amount of risk they're willing to assume. But since this is a major reactionary low, in other words, this is the obvious turning point on this time frame. Just like this is an obvious turning point. This is an obvious turning point. This is an obvious turning point. Here's one that's obvious. Here's one that's obvious. Here's another one. Here's another one. So when we look at those reference points that just literally jump off the chart at you, they're the ones you're primarily focused on, because that's the one everybody else's eye is going to go to as well. And because of the nature of how obvious these highs and lows are relative to the daily time frame, it makes identification on liquidity pools, which is above an old high, it's buy stops, because our assumption is when the market's dropping, some entity is short in that condition. So they're going to protect their short position with a stop in the form of a buy stop, just like anyone else. They're going to protect it with a buy stop resting above an old high. And the understanding is if it goes to that high, they don't want to incur more loss. They're willing to submit to the idea that they were wrong. So above old highs is buy stops, and below old lows are sell stops. Now, what makes a low resistance liquidity run high probability is the fact that we've only got one turning point right here, and it didn't spend a lot of time there. It hit that level and then traded off of it. So as we started consolidating, okay, see how I was consolidating in here right before it punched down below this low. We're going to talk about, and I saw your question, Thor, or comment about not being willing to see this as a long in here. And I'm going to show you why that was actually a viable condition, because it's off of the daily chart. But when the price is ready to expand, many times it'll go right into consolidation. And because of the interbank algo, the way it delivers price, it will offer the market a tight consolidated range, allowing participants to build in orders. Above this short-term high would be buy stops. Below this low would be sell stops. The essential takeaway is, where's the least path of resistance to get the next level of liquidity? The market has been dropping. You have this level down here with a big pool of sell stops below the marketplace. Is this market most likely going to stop here and go straight up? Not likely. Now, obviously, some of you, and especially the new folks that weren't here watching daily in September when we were talking about moves before it happened, it's important that you understand conceptually that before big moves happen, or when these big runaway moves take place, there's a consolidation that takes place. In other words, it's a little pause or a little trading range type idea, and that sets up the next big price swing. So if the next price swing is aiming most likely for these lows in here, because there's sell stops below this for those that went long and bought, as this starts to drift down in here, these orders are the next logical target. And if we get down to that level here, is there anything really over here supporting price? Because the bodies of the candles on this swing low have already breached the bodies of the candles here. We identify and we're aware of the wicks, but we're more primarily concerned with the bodies of the candle. So this swing actually violated this low. Even though it doesn't look like it, it did, because the bulk of the volume is in the bodies. This expansion is all going to be different, and I'm going to give you an example of what I mean by that. If we look at the delivery of price for July 6th, 2016, the low on this feed is 127.90. Okay, 127.90. So if we were to tweak our respective low for that given day, I guarantee you there's going to be a wide disparity between everyone's data feed, because it was a run on liquidity. It was an expansion down to run stops. So every broker or every liquidity provider that you operate through, they're all going to have a different low, because they're going to expand through where their book is. So they can see what in their own house of private liquidity, they can make a run on their own customers, and that's allowed by law. They can do that. You sign over the rights for them to do that. When you sign up and open up an account, you're basically saying, take my money when it's available. And that's the nature of this business. So not only are you competing with just a general price action, but many times you're actually dealing with the competition of your broker, which will cannibalize you. So when we see this low here, we're not specifically looking at the low itself. We're looking at the bodies of these candles in here. Okay, so to give you a better understanding of what I mean by that is, this low is really, in true form, it's this. That's the actual low. These wicks are just running for liquidity. Now, we have to be aware of them. I'm not saying that they're not something to be monitoring, but when price trades down through it, okay, this is essentially a run on this low right here. even though we have two wicks that went lower than these bodies, and essentially this wick went below this low here, this actually cleaned out the liquidity below that low. And we'll talk more about that when we talk about institutional pricing. But for now, let's keep our discussion focused on the actual lows, okay, because everybody else is going to think about that too. So we have price consolidating right above an old low, and we know that there's sell stops below it. If it gets to this low by running down here, okay, and expands lower, it's not likely that it's going to come down just below this low and then reject and go higher. It's going to go for the next close proximity for liquidity, which would be this area over here under this low. Okay, so when I tweeted the chart to you, let me see if I can get this little bugger to shift me over a little bit so I can work with this chart. There it is. If I can just get it, there it is. Thank you, Jesus. All right, so looking at this chart, we have the low, and again, focus on the bodies of the candles. It's cleaning out the lows here with the bodies, not these long wicks. Don't pay attention to that. You're looking primarily at the bodies of the candle. So we clean that out, okay? And we talk about turtle soups later on in this mentorship and rejection patterns. You're actually going to see this is being taught to you like this. It doesn't necessarily need to go through the wicks. And that's my, I guess, my deposit into what I learned from the Street Smarts book by Larry Connor and Linda Rasch. They sent a wonderful pattern to the trading community in the form of a turtle soup break, false break above a 20-day high or a false break below a 20-day low. And while I don't require that many bars or that many candles to see a trade setup, I can do it with just 5 candles. So it doesn't need to be 20. And by having that, this right here, this low, wouldn't be seen as a turtle soup, and by definition that was described in that book, Street Smarts. But the way I view price and the way I'm going to teach you is that this is actually turtle soup because it's a false break below the bodies of these candles. So the bulk of the volume in this turning point in here is actually seen in the bodies. So that's why we spend very little time looking at wicks. The only time we pay attention to wicks is when we're looking at fair value gaps, and we're going to talk real specifics about that this month as well. I only introduced it last month, so you're going to get a lot more detail. And when to use the body of the candle and the wicks, all that's going to be explained to you this month. So all that problem of struggling with that it'll all go away. all the free content that I didn't give you, okay, it fills in this month in regards to order blocks. So we have the consolidation in here, okay? Price is in consolidation, and it's doing this right above an old low. Now this old low has a down candle right before this expansion move. So this down candle, we know that who buys when the market goes lower? Smart money, banks, large institutions, because they have to buy when price is going lower. That's the only way they're going to get efficient pricing. Otherwise, if they bought while it's still here, the volume that they're trying to price in to their orders, they're going to get so many inefficient fills, it won't be a good averaging in on their position. They have to get as close as they possibly can to a range of average pricing for their orders. Otherwise, they get in a lot of trouble. So to do that, they have to do orders buying when the market's going lower. Okay, so when banks buy, they're doing it when the market drops aggressively into a level. You're going to need to learn that, and we got a lot of exercises that help you discover how that's actually the most efficient way of doing it. You don't want to be buying when the market rallies. And then for some of you new that just signed up, you probably know what it feels like to see these types of moves here. Then you want to be buying it. You feel comfortable buying it then. You're going to learn that you need to be buying it right when this candle is all the way bold-faced down, not when this wick forms. When it's down here, that's when you're going to be looking to buy. Just as well as when this down candle here, we identify that as a potential area of institutional order flow with buying orders, buy orders. Why would we expect that? Because there's a big move off that low. This is the last down candle. So we reference that over here. So to answer your question, in regards to why that one trade wouldn't be a good viable trade, yada, yada, you look at the daily chart and you'll see the order block reference points. You have opening 129.12. The low in this candle comes in at 129.12. The low in this candle comes in at 129.13. So it's working off this order block here. So you get this reaction in here. So this retracement into the bearish order block, this up candle, right after this down move here that violated this low, this whole concept right here, okay, is crouching above an order block. That means it's just pausing, letting orders build up, so that way they can expand price down to where the least area of liquidity would be resting below here. Basically, it's like this. Think if you went long here and say this wasn't a daily chart, okay, and you know exactly what I'm about to explain to you. You know exactly, intimately what this feels like. Everyone has. You went long here, we're assuming, okay, and you went long, you held on to the position, and you got married to the position. It's going to keep going up. Then it starts to come down, and you're thinking, okay, it's only a little retracement. It's going to keep going higher. Then you see this, and you're thinking, oh, Jesus, let me see it come back up. I want to get out of this thing. And it never does. Then it goes into this pattern here, and the whole time your stop loss is below here. So this whole point at which it's doing this is all a psychological ploy, okay, to allow sentiment to shift. If there was no stop loss placed, they're going to place them here because people do trade without stops. But if they hold price here, those individuals that did not have a stop below that low will now put a hard stop in there. See, a bank can't pair up against a mental stop or a hypothetical stop or well, if it goes there, then I'll execute. It has to operate as a counterparty against a hard stop. So everyone that's in a long position here and it's still being held in this condition here, they're going to have that squirming feeling of anxiety, all that stuff, that they know that their stop's about to get hit, but they won't get out of the trade. Or traders that will not relinquish the idea, okay, of this trade, they stick to it, they marry it. So then if they didn't have a stop loss, they'll put it underneath that low now. So this is all engineering, okay? This is all engineering of liquidity. They won't let it go down there below that low because they want traders to believe that there's liquidity safety in the form of putting their stop below that low. It's okay. Don't worry about it. That's where it should be, because the banks and the market makers, if they even know what a market maker is, they're just going to be nice to them that day, and they'll just scare them, but they won't take their stop. Well, that's not what happens in the price. Obviously, once it hits a bearish order block and where they can reprice new shorts, then they expand price going lower. And true to form, if we're going to take that low out here, they're going to run this low as well. And you see that here. That's what the tweet was showing and identifying where the market's going to reach for first. So you're going to get a lot of that stuff as we go through the mentorship, and there are opportunities for you to study on the lower time frames, 4 hour, 1 hour, 15-minute, if you're able to do it. If not, live, at least do it on a hindsight basis after you get home from work or whatever you're doing that keeps you from watching it live. So having this understood, okay, and this being a low resistance liquidity run, meaning that there is nothing but this one little turn preventing price to expand through that, okay? Contrast that with, we have this whole big block of price. You have this big block of price up in here, okay? This run through all this, the bodies of the candles in here, this is actually right here, this point, from this point here to here is identified as a high resistance liquidity run. Now, in the lower time frames, this little portion of price action becomes a low resistance liquidity run. So it's going to be relative to the time frame you're looking at, but looking at price down here, it's got to get through a lot of price action to get above those highs in the bodies, not the wicks, the bodies of the candle, okay? Now, what I was just describing relative to these bodies down here and this swing low swinging through it, taking out the lows of what will be formed with these bodies turning here, we breached that by the bodies of these candles, then expanded higher. The bodies of these candles here, okay, that's all was necessary to run through. Notice that this high here, yes, it went above the previous high, but it didn't go through these wicks because the bulk of the volume on selling is all seen in the bodies of the candles. So that's all that was necessary there. So on a lower time frame, this is actually a low resistance liquidity run. But in regards to the current time frame, if we were looking at price right here, to get above these highs here, it would be a high resistance, liquidity run. And you have to trade them differently. Different parameters, different ideas. But it's still a trade that can still be taken, but you have to understand the context of what you're trading through. And it helps you lower your expectation in terms of the magnitude or the velocity of how far price will go and what speed it moves. So let's look at this real quick. Let's break it down, and I'll give you some examples on how you can go in and start looking for 6% setups. Let's go into an hourly chart. Now, if you tap Control Y on your MT4 platform, you get the regular day dividers, and obviously we don't use that, but it gives us the retail perspective on what the day looks like. We always go in with identifying where the midnight candle is. And I'm going to keep these blue to save time. You'll just have to allow me that luxury today to save time. Okay, so now we can take Control Y off. Okay, now we've defined the daily ranges. Okay, this is true high, true low, and close, dead time. Okay, true high, whichever's higher in here. High comes in at 128.46, 128.52, so this is the high of the day here, and price expands lower. These levels, these horizontal lines, okay, all they are the liquidity pools that were identified on the daily chart we just came from. Okay, let me drop back out to a daily just so you can see what we're talking about, because I may have lost some of you. Okay. It's the actual order back. Actually, I messed that up. The low here and the low here, that's what we're identifying here. So then we go back down into, I'm glad I did that. Okay, so here's the price moving below that first low where liquidity would be resting below it. Okay, price goes through it, dips down. We have one low, it rallies up a little bit, drives through again, takes the stops out. What was resting below this low here? Sell stops. Okay, so once the sell stops are ran, now this is for your notes, okay? This is one of those times where you got to be using your pen. You can use a pencil, I guess. If the market is predisposed to go lower, okay? If the market's predisposed to go lower and it expands down as it should, and it clears a level of support, this is what we're seeing here, that level here, it breaches it, expect a minor little break and then hang around it and maybe even retracement. That's a normal reaction, okay? It'll come up a little bit and then you want to see, does it want to drive below the low it just creates once it breaches that initial low? That's what you're seeing here. It retraces a little bit. Now here is the millionaire making concept that you need to be aware of. Once it drives down again, after the first run through support, once it runs through there and it bounces, there's going to be buyers that think this is going to be a low, because traditional support resistance says that this low here that we referenced on the daily chart, all you have to do is put a horizontal line in your chart and then just, it's that easy. Just buy it when it gets down there. So when they offer that little bit of a rally, people are going to be buying it and they're going to put their stop loss right below that low. You're going to wait and see if there is an opportunity for them to run back down there and get those stops. If they do that, you know that there's most likely a stronger opportunity for them to keep expanding this thing lower, because they're killing those individuals trying to catch a low. That's basically tipping their hand to you. If we were at a poker table, okay, and the smart money was on the other side of the table to us, it'd be like them saying, okay, here's what I'm holding right now. Here's my cards. In price action, they're giving you all the indications that this thing wants to go lower. Now, the retracement higher off of the first support level, that's a normal characteristic. Now, sometimes they won't even do that. It'll just drive clean right on through the level and it won't even turn back. But if it gives you these opportunities, you want to see it bounce there, come back a little bit. Once it blows through those lows again, now you're looking for markets to go back to fair value. What's fair value? Well, I taught in September what that is the market's going to expand and create a one-way movement, which is, you see here, 1 down candle, 2 down candle, 3 down candle. Okay, so we've created a small little liquidity void where everything is all one-sided. There's no up candles in there. They've only offered price on the sell side. Lower, 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 lower. Okay? So if we go into this price action here after we identify something, okay, we're going to look at specifics in here. To get 6% a month, you only need one setup per week. You only need one. The things I taught you in September, we're going to build on each one of those components over the next 4 months. When we get to the 7th month, when you get into more detail about things that you haven't learned in the free tutorials, it will be very quick for you to go in and see the chart and say, okay, there's an opportunity. And more importantly, you'll be able to look at the chart and say, you know what, I have nothing to do right now, and I got to turn the charts off. And that's the discernment you're going to have. But when we see price action giving these opportunities like this, number one, you frame the levels of liquidity on the daily chart and 4 hour. If you trade with those levels, you're going to get the highest probable setups. It doesn't mean that there won't be opportunities on the lower 1 hour charts, okay, that's set up that you will see take off and you won't be a part of. But if you want to trade with the highest degree of institutional sponsorship, that means that the banks are actually behind the moves and they're really going to push price far. That means you're trading bigger magnitude trades with higher velocity. What's velocity? How fast the market's going to move away from that level. The market can't move fast away from something that's on a 5-minute chart. If you're seeing movement on a 5-minute chart that's fast, I guarantee you're finding it on something that's relative to a daily or a 4-hour chart. And what I mean by that is something's providing support or resistance relative to a daily or 4-hour. Price does not move off of a 5-minute chart. It's just reflecting price action. But price is designed to move off of reference points institutionally that's on the daily and the 4-hour chart. So if you do majority of your analysis, and some of you are actually concerned about this because I do a lot of intraday talking and teaching, but it gives me a lot of opportunity to give examples. But if you listen to what I'm telling you here, daily and 4-hour levels are essential for your understanding regardless of what kind of trader you are. I mean, if you're going to be a day trader, it's going to make it even better for you. If you're going to be a swing trader, it's obvious that's where your trade's going to set up. If you're going to be a short-term trader, you got the best of both worlds. You have the blending of what day trading can give you for entry with swing trading setups. So you can do very, very short-term trades with high payouts with low risk. So you can do a lot more gearing with short-term trading. Day trading, you got to keep that balanced a little bit and don't get too crazy with the risk. And obviously swing trading, you got to really keep the risk low. So if we look at this, we see price run one more time below that low. Okay, so if we see this, we've seen them make a run on the liquidity below that initial low in the daily chart. Then they have a little retracement, and then they run one more time for those individuals that want to try to buy the low. When you see that, they're going to create that quick, sudden run down. And when it happens, they've created a void in liquidity. It only offered the sell side. They keep repricing lower, 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 lower to make a run on the initial buyer's sell stops. When they come through those and they come back up to that level again, if it can do it, and it won't always do it, but if it can do it, you're just going back to fair value. What did they do here? On this up candle, who sells on up candles or up movements? Who sells in that? Smart money. Now, specifically, if we look at the range created by this candle, and this candle, and blend these three together. Now, I don't have a capacity to make a 3-hour chart, but I want you to look at how the range is defined here. This is the actual order block. It's the body of the candle here to the body of the candle here. That's the bulk of the volume. If we take that and define it with a fib, you can see price goes right up into equilibrium. We allow to trade through a little bit. That's normal. But look at how the bodies are being kept at bay. This is only reaching up for stops on a lower time frame. That's all that is. It's protraction. Market expanding up into an area just to get liquidity. But the bulk of the volume, the bodies stay below that equilibrium price point, which is half of the range that would be created by these candles. Now, if we used the high to the low, you don't get so much of that. You get disparity because you have the wicks and you're focusing too much on the inability to hold price in the bodies. This wick action is always defined by stop running. So we don't care so much about the wicks. More specifically, the last up candle, we do focus on that. That is a bearish order block. So as price goes back up into here, as it hits this moment right there, inside of this low, up to this body's candle's opening, okay, the body of the candle where it starts and it's low. All below that point of opening down to the low, that is actually fair value. What's it fair value for? It's fair value for them to sell more. They can't sell it down here. The banks can't sell it down here. They have to allow price get back to an area where it's economical for them. And it's not ambiguous. It's not something that's hiding from you in the charts. It's very clear. It's discernible. You can see it repeats itself. And you should expect it to occur here because they've already cleared this low out on the daily chart. And they're consolidating again. Okay? Now think, we're in this little block of price action. What's about to happen? Expansion. And once it hits that level, it expands down again. Doesn't clear the low, it just stays in the range. So what are we seeing more of? Consolidation. What's going to happen after consolidation? Expansion. That's the only thing that can happen. It expands out of the consolidation. Once it starts to show a willingness to go lower, where's your idea in terms of directional bias? Where is it going? Because we've already worked this level here. So now this level is no longer salient. Take it off. It's gone. Where's the liquidity at? It's going to be below this low down here. So every time you see the market make a impulse price swing lower, here's an impulse price swing lower, here's an impulse price swing lower, here's an impulse price swing lower. Taking what we learned in September, all you're doing is you're looking for price to return back to fair value. And you anticipate price to create new selling opportunities every time it gets back up to the up candle, wait for the down move, retracements in here, it goes right back to the order block, right into the middle of the order block here, fair, the mean threshold, it respects that here, then expands, runs the liquidity out here, and then one more time it goes back up to fair value, where they can sell it again at a bearish order block, and then boom, it explodes lower, clearing out the liquidity. Now, look what's going on here. They've taken all the stops out below that daily low, the lower low that we've identified was a liquidity pool. We expanded through it, and now we're consolidating. So we've already we absorbed all that now. So the most likely condition would be there's been no run on stops above the marketplace. So anyone that's short prior to all this in here, or post all this price action, in other words, everything to the right of this high, there's been no runs on liquidity on those individuals that are short. You have a short-term swing high in here, and it's also at that old low. So the next area of liquidity would be right above this high, 127.92. So we got 127.95 to 128, big figure, and we would study this and watch and see if we get expansion to run out that liquidity. Now this is an hourly chart. It's not a lot of range there, okay, but it's a way of studying it. We have a down candle. Price is in close proximity to that. We've already escaped the down candle, so we could potentially see this expand up to 120. What did I say? 127.95 to 128 big figure. Okay, that's the next area of liquidity. At the same time this was occurring, the dollar index was making a run for this high, and it still could happen. I mean, we're in an earshot of that. Okay, but look closely in here. What I just taught you relative to highs. Everyone's got this high noted on their chart. That's what the retail-minded trading concepts teach us. But this is the actual high. All these wicks are all going to be different relative across the spectrum of everyone's trading platform. It's all going to be different. You can see how they cleared it out over here. So in terms of looking at the highs, this high here, let's look at it. the high comes in at 96.30, and this high, not that one, this high comes in at 96.31. So this high technically has not been violated over here if you're looking at the wicks. But I'm telling you, the reach for liquidity is right above this body of the candle. That's the highest of the bodies of the candle. And that's all you would need to aim for. If you want to aim for higher targets than that when you're long, that's all on you. I'm not that type of trader. I don't go there. I want to know where it's highest probability for me to offload, where the banks are going to want to offload. So if they're long, they're going to want to take their positions off and scale out. That doesn't mean they're pricing in a high or the top. It just means that's where they logically take portions of their long positions off. So let me give you an exercise and how you can start practicing and looking for setups, and then we're going to close this because I got to meet with the people over in the other webinar for those that started but they can't get their account set up. So if we look at, let's go back to this. Where are we at here? Here we are. So again, let's have this in mind. That's the area of liquidity next. We drop down to a 15-minute time frame. It's a little bit more clear this way. Okay, so price has broken a swing high here. We have an impulse price swing. It may not, because it's too close in proximity, may not allow it to give us a retracement. But if price was to come back down and touch the top of that candle, 127.57, if it hit that, we could reasonably expect that to offer some support. If we run a little bit here and take out this candle's high, we got to focus on this down candle. Okay, and you watch the middle of these down candles, they need to be supporting price. But just for volatility study only, you want to watch and see if it makes a run on the stops here, because there's been no runs on any trailing stop loss orders for those that are profitably holding short positions. And this is the beginning basis points of understanding how to determine where the next direction of price is going to go, by knowing where the next area of liquidity is, which one hasn't been probed most recently. Now, if you look at the setups, okay, every single day, you want to look at 3 days worth of data. 3 days worth of data. Now, why 3 days? Why did I just pick that number? Well, it's been taught to you actually in the free tutorials for years. If I talk about a pattern relative to a daily chart, and I say, if I draw your attention to a specific price point, I say, okay, this is a swing low. If I say a swing low is in the marketplace and I'm drawing your attention to it, what is it? What am I referring to? It's 3 candles, one lower candle with a higher candle to the left of it and a higher candle to the right of it. If you understand that simple little price pattern, okay, and it's not the Bill Williams fractal pattern, everybody pops up on their chart up here, and I'm not going to do it here. But all you need is this. You have 1 candle, 2, 3. Now, this is obviously a perfect textbook swing low. They're not going to look like that. Sometimes you're going to have the low form something like this, or it could be something like this. Doesn't matter. As long as you have a candle that has a candle to the left of it with a higher low and a candle to the right of it with a higher low, this is a swing low, or a ring high, we used to call it before electronic trading, where we had to actually draw our charts out with our hand, put the little open, close, high, low together. Yeah, that's how old I am in this stuff. Once we would see a swing high, which is a high with 1 candle with a lower high to the left of it and a lower high to the right of it, what you're seeing is a swing high. And when we saw this form on our charts, we would draw a little ring above it. Now, the significance is this. Why do you have to look at 3 days? I don't care if you're a swing trader, if you're a day trader, position trader, a scalper, okay? This is where your attention starts. Because over the last 3 days, okay, price has done something. Now, you may not have been aware of what price was going to do at the time. You have no idea what it was going to do. but you can look at what it has done to give you setups going forward. If you see price on a daily chart, create this type of formation here, which is a swing high. Let me go out to a daily real quick. There's a lot of business on that, isn't it? Okay, on the daily chart, here's our last swing high. There's been no swing lows because we broke it. So this is a swing high. We have a candle here, with a lower candle here to the right of it, and a lower candle to the right, left of it. And price expanded lower. So on the daily time frame, this market move has been moving away from a swing high. It's yet to make a swing low on the daily time frame. And it's reached below this low here like we talked about. So institutional order flow is what on the daily chart? Is it bullish? It's bearish because we've created a swing high and we're expanding lower and we're reaching for this low over here, which we've already cleared out, and the low, which I can't show without goofing up this chart, that over here, this low. So when we look at price, every single day, you want to look at price, what it did the last 3 days. And why is that important? Because you're going to factor in the likelihood of a swing high or swing low forming while you're looking at price live. So what do I mean by that? If we have the daily ranges referenced, okay, and we're looking at the, I'm actually going to have to change the top color on this, otherwise I will confuse myself. Okay, this is for the folks that are just chomping at the bit. I need to see live trades. You have to see these things first, okay, and understand why I'm doing it. Because if you just indiscriminately go in there and try to copycat what I'm doing, you're not going to learn anything. Even if we make money, you're not learning anything. At the end of the mentorship, you'll have profitable trades and say, yeah, that was great, but then you're going to miss me once we stop because you didn't actually learn. So I'm here teaching you this stuff, not just to show you I can do it. So if this is today, okay, now we're going to have to use a little bit of hindsight here, and we're going to have to use some hindsight over here, and we're going to have to use some hindsight over here, okay? But it's just, that's the nature of the beast. You got to do it. Here's Tuesday's trading in here. Remember, we're working off of a daily swing high. We've seen expansion continuously going lower. We've identified where the market wanted to go because of the swing lows or whether those liquidity pools were on the daily chart. So we know that the price is going to reach for that liquidity. If price is going to reach for that liquidity and it's on the downside, we're going to focus primarily on the retracements moving higher. So in other words, we're focusing on markets that go into a premium. So what does that look like? Well, here's Sunday's trading. This is last Friday. Here's Monday's trading. Okay. So we have price Friday making a high here, and it comes and gaps down through it on Sunday's trading. And we have all this consolidation in here. Every time we create a new range or impulse swing, we have to reference that and determine, are we in a premium or are we in a discount market? Because we have our day dividers divided up to day in true day format, what we're looking for is the market to move I didn't want to do that. There you go. We showed this yesterday. Market goes into a premium here. We can sell that. Price expands lower. Every time it creates a new impulse leg over the last 3 days, okay, so now we see this market move here. Okay, the market moves from here to here. We would draw a fib from this high down to that low, and all we're doing, the Fibonacci doesn't do any magic there. It just draws your attention to, are we moving above equilibrium? If it is, we can sell at a premium price and allow the market look for a low to run out. even though there's a gap in here, okay, it may not appear on your chart, but we have this high down to that low here. Does this market get up to equilibrium in here on this price leg here? No, it doesn't. We have an impulse price swing here. Does price get above equilibrium in that price leg? No. In this impulse price swing, does the price get above equilibrium here? Yes. And it does it towards the end of the day. You're used to seeing trades that only occur in London Open and New York Open, and sometimes London Close. There is a New York Close setup that occurs, but it has to be on a higher time frame basis. The reason why the red line's here and why I identified 3 o'clock in PM is because that is when the bond market closes. So that really officially ends the day for interest rate driven markets. So since currencies are essentially driven by interest rates, if you're going to speak fundamentally, that's where the actual end of the day really needs to be reflected on, not London Close. And that's the reason why true day format is why the algo delivers the price like it does. If you're looking for setups, okay, and this is one of the ways you can do it, is you want to look for impulse price swings inside of the daily ranges over the last 3 days. If you know what the most recent price direction is on the daily time frame, you know what side of the marketplace to work on. You know that this low down here was going to potentially be aimed for because there's liquidity below it. And the the higher low that we identified on the daily chart at the beginning of this video and tweeted the chart yesterday was that these levels here would have stops below it, and we saw that. Price goes below it here, ran up, went through it one more time, retested it, and then expanded lower. So when we see price giving us impulse swings lower, we're waiting, we're not chasing it, we're waiting for it to go back up into fair value. Okay? So when we see each one of these impulse price swings, here's one, here's another impulse price swing. Here, do we do anything down here? Do we sell it right away? No. We wait. Does it get above equilibrium? Yes. It goes right into premium. Then you can sell it there. And it does what? Runs down below previous low. The market gives us one more impulsive price swing, goes lower. Does it get above equilibrium? Yes. It's in a premium now. So we can sell it. Then it drops down. It's not going to give you every single price swing, but it's going to give you the ones you should be in. Okay? So if you're looking at a bullish market, the only thing you do is reverse it. Every time you get an impulsive price swing that moves higher, and the daily's giving you an indication that it's going to reach for liquidity above the marketplace or where it's trading at currently, when that is in place on the daily, all you're doing is looking for impulse price swings if you're bullish now. When it moves higher, you just wait for the impulse price swing to go up, then you draw your fib on it and you identify what equilibrium is, and when price drops down into that, inside these intraday ranges, okay, you only need one. You only need one setup to do that 6%. Remember, we gave ideas about, let me take all this off here. And I have to actually close it. I got literally 2 minutes to do this. Pressing it. The impulse price swing here, down. Okay. What is this right here? What's this little green thing here? It's a bearish order block. It's a bearish order block. Price trades right up into that bearish order block right there, inside of a premium. Okay? So if we're going to sell it there, and yes, you're going to see me do this week live for those that just signed up. I want to see live trades, Michael. You're talking about hindsight, Michael. I'm paying you good money, Michael. You'll see it. Just relax. All right, so if we sold it here, price goes down to this low over here. There's 33 pips. Now, framed on the idea that I talked about yesterday, is that not a viable trade where we can do what? If we're looking at this swing as a sell and we're going to take profit down here at 30 pips, if we do a risk of 30 pips, 1.5% risk, there's your one-to-one payout. There's 2-to-1 or 3% return, 4.5% return, and that's where we're at. So again, only looking for one setup per week. That's all you would need. You're done. And you do it again next week, and you do it again next week, and you do it again next week, and then all of a sudden at the end of the month, you're over 6%. And if you do that every single month, you double your money. So these are the ideas we're using from the September content and applying it going forward. And there's going to be a lot more to it, and you actually see me actually do it in advance. We'll talk about where it should go and all that business. But for now, I have to close this session and go back over to the other webinar for those that have issues with their account. So I'll give you a recap today, a recap video, and then tomorrow we're actually going to do some live trading. So I'm going to wish you a very good afternoon, and good luck and good trading.